That's what I'm trying to focus on. And so private equity in the cases I'm discussing are the very largest firms, the KKRs, Blackstones, Apollo, Carlyle, that are using heavy debt loads to acquire companies, make them more efficient, so they say, and then sell them within a relatively quick time frame, 5 to 7 years. And so my argument is that this strategy actually adds a couple of very intense pressure points on the companies that are acquired. My argument is that while these deals benefit a small coterie of firms and executives, there really are a lot of other people, other stakeholders that can be hurt by them.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. We talk frequently on this channel of the dangerous and worsening wealth gap between the rich and the rest of society. If as a regular individual investor you feel the playing field of today's financial system is unfairly tilted away from your interests and towards those of the already wealthy, today's expert would say you're absolutely right. To delve into this topic more deeply, we sit down with Pulitzer-prize winning and New York Times best-selling investigative journalist Gretchen Morgenson. Gretchen's renowned for her groundbreaking reporting on the financial markets, with a particular focus on the way in which they are too often abused by Wall Street power players. Today, we'll discuss the key takeaways from her new book, These Are the Plunderers: How Private Equity Runs and Wrecks America, which was recently published and is already a Wall Street Journal bestseller. Gretchen, along with her co-author Joshua Rosner, exposed the world of private equity as insidious, claiming that a small cohort of elite financiers and their government enablers use excessive debt and dubious practices to undermine our nation's economy for their own enrichment. To learn how, let's hear from Gretchen herself. Gretchen, thanks so much for joining us today.
Happy to be with you, Adam.
Gretchen, it's a privilege. I'm super excited to dive into you in the details of your new book. Very quickly before I do, especially given your perch there in the, the journalist, your journalist role, being an investigative journalist in Wall Street, having been steeped in that market for decades now. What's your current assessment of the global economy and financial markets?
You know, we have enjoyed a tremendous run, of course, as you know, in the stock market, the overall stock market. We're just now starting to see some earnings weakness a little bit. Maybe the expectations weren't quite met at some of the biggest companies that have been driving this rally. But I think overall we're in pretty good shape. You now have economists arguing amongst themselves about whether we will have a recession at all, or whether it will be something that would be, a relatively soft landing. So I think we are enjoying a really good moment and have done so. We probably second half of the year, we'll be looking at a little bit more turbulence and a few more of the unmet expectations, because as you well know, investors, when they get ahead of steam, they really have high hopes for their companies that they've, been profiting in, and they just hope that that continues. Of course, these things never continue forever, but we've really had a pretty good run. So I'm here to say I am not a doom and gloomer right now, but I do think people probably should ratchet back a little bit on their expectations.
Okay. And of course, we're talking there about the public financial markets. Your book is really on the private markets, right? So let's zero in on private equity. We have had a specialist on this channel not too long ago talk about the private equity markets, but I don't want to assume that every viewer here watched that video. So if we could you just briefly define what the world of private equity is?
Well, private equity, and particularly the firms that I focus on in the book, private equity is the current iteration of what we used to call leveraged buyouts and what we used to call corporate raiders. Okay, so this sort of investment strategy came out of the 1980s. And we all know about the RGR Nabisco deal, which was
Mhm.
described so well in Barbarians at the Gate. And so for the past 30 plus years, we have now seen many, many, many kinds of these deals. They've gotten bigger, they've gotten more impactful, and they're affecting many, many more stakeholders. And so that's what I'm trying to focus on. And so private equity in the cases I'm discussing are the very largest firms, the KKRs, Blackstones, Apollo, Carlyle, that are using heavy debt loads to acquire companies, make them more efficient, so they say, and then sell them within a relatively quick time frame, 5 to 7 years. And so my argument is that this strategy actually adds a couple of very intense pressure points on the companies that are acquired. The first pressure point being the heavy debt load that is used to acquire the companies. And by the way, those debt loads and the expenses associated with them are paid by the company that's acquired. They're not paid by the firms that are doing the acquisition. So the company that's acquired has a new and very costly expense that it has to meet. And then, you have, of course, the reaction to that new cost. How, if you want to make a company more efficient and sell it within 5 to 7 years, you're going to have to make some pretty radical changes. So what that often involves is job losses, job cuts, pension cuts, cost cuts that affect the quality of the goods and services being offered. And so my argument is that while these deals benefit a small coterie of firms and executives, there really are a lot of other people, other stakeholders that can be hurt by them.
All right. I think there was a line in the book, which is, we are all worse off because of private equity. And again, I'm assuming you're talking about kind of these really big behemoths that come in and kind of follow the script that you're talking about here. So it sounds a little bit like, private equity, the term private equity, at least in the way that you're writing about it in your book, really it's a rebrand. Right. It's
Yes.
it's like trying to call, RJR Reynolds Altria at this point in time. It's still a cigarette company. Here it's LBO, just by a different name. Right.
Right.
So let's delve into those pressure points here. And you write about a few more in your book, but I think they're probably, they nest under those two really big ones that you mentioned. So you talk about the heavy debt load. So obviously these companies are massive companies with big war chests. Are they putting up 100% of the money themselves to make these acquisitions, or are they using other people's money in certain cases to do this?
The big firms are using other people's money to the vast extent. So they'll put up maybe 1 to 2% of their own capital to make the acquisition. And then what they do is they raise very large funds from public pension investors, institutional clients, endowments, entities like that, that give them money to invest and to put to work. And so the firm will take that money and then use it to acquire these companies. So it really is an other people's money game. And for many years, as you know, it generated outsized returns for those investors, for the pension funds, for the institutions and the endowments, et cetera. Now those returns are reverting to the mean. And so you have situations, I think there was a Wall Street Journal story just a week or so ago about this, where the pension funds are actually now losing money. These returns are now negative
Right.
for the first time. And so, yeah, you're really going to have people start to question this, I believe, in addition to the other elements, the other pieces of the puzzle that we outline in the book about the harm that can be done by these companies in these acquisitions.
Okay. And I'm curious, how much of this reversion to the mean is just mathematics, right, where eventually you have to mean revert, or how much of it is due to the current hiking and tightening campaign of the Federal Reserve, which maybe a better question is how much of the boom, the salad days that private equity have enjoyed were due to ZIRP, were due to interest rates being kept near all-time record lows and enabling the debt financing to occur because debt was so plentiful and so cheap.
Such a great question and really, really important. Yes, I mean, I would say ZIRP is the key piece of the puzzle. And that is an explanation for so much of what private equity has done over the recent years and also for the boom in the field. But yes, so now we have rising interest rates, and we now are starting to see more bankruptcies because these companies raise debt that is floating rate debt. They do not raise fixed rate debt. And so as rates have gone up this year pretty dramatically, their costs are rising dramatically as well. I think S&P had a recent report out about this year there are more bankruptcies. We're on track for more bankruptcies among private equity companies than we have seen since 2013. So yes, rising interest rates are a huge negative for these companies. But so I would say it's almost as though the business model really requires almost perfection in a certain, pieces of the puzzle just have to fall into place, one being these low interest rates. But you also, it's interesting to think about the trajectory of the 30 plus years that these buyouts have been dominating. So back in the 80s, when you had the RJR deal, when you had other acquisitions, we were coming off a really, really negative period for stock prices. And the valuations were extremely low. In fact, the companies were undervalued. And so it made sense.
Sorry to interrupt,
Yeah.
but I'm wondering maybe part of that was because at the beginning of the 80s, interest rates were super sky high. So cost of capital was bananas high, right? And that caused Wall Street to, heavily discount these companies. So again, just underscoring the importance that interest rates play in all this.
Absolutely. Great point. And so you had these really terrible valuations in the stock market. You're too young to remember, but Business Week had a cover story, death of equities. And, I don't know, in the 70s, it was all over for the equity market, right? And so during the 80s, when these takeovers started to occur, there was really a variation between value and, real value and market value. And so they were capitalizing on that arbitrage, and they were shrewd and they were smart. And the debt loads that they put onto these things could be covered because of that mispriced value that the public stock markets put on it. Well, we don't really probably see that now. We have not been in a tremendous bear market as we were in the 70s. And so you don't have the valuation variation that you did then to make up for some of the costs that were associated with this business model. That's a big part of, I think, what's going on now. And they're not having as easy a time finding deals, and they're also, interestingly, not having as easy a time finding buyers at the end of the line. Now, when they take over companies and want to flip them 5 to 7 years later, often they will sell them into the public markets in an IPO. We, have had a couple of periods where the IPO market recently has not been receptive. And so that's been a difficult pressure point for the firms as well. So yes, the business model is being tested very severely right now. And it's going to be interesting to see how the firms come out of it and whether there are, pretty severe bankruptcies.
All right. You're just raising so many questions. I'm excited to delve into you with here. So you already, I think, answered one I was going to ask, which really is, how does the private equity investor get their return? Is it more of a flip in general, where they're coming in, they're making the company more efficient, air quotes, and then they're selling it to another buyer who's excited to buy this quote unquote more efficient company?
That's right. That's the argument. That's the thesis. And, again, it requires there to be fat to be cut. It requires that there be inefficiencies that can be, avoided and gotten rid of. And so, is that the case? Well, I'm sure that many would say, yes, there are plenty of companies out there that need to be, whipped into shape. But it is this short-termism that is another part of the unsustainable part of the business model, in my view, right? We've all talked about how short-termism in the stock market is bad, the focus on the quarterly number and how the focus on that really takes executives' minds away from the, true business at hand, which is growing the company, building the company, making shrewd acquisitions, et cetera. So the short-termism that is central to the private equity argument is, I think, also problematic. Now, if they can't get out, then the pension investor, the institution that's invested in it, then they'll start to feel the pain of the business model. We are starting to see that private equity firms are not getting out as easily. We're starting to see them sell to each other, which is a kind of a sure sign of, top of market or end of kind of, market peak type thing, where you'll even see, in one case, you'll even see Apollo selling a company out of one of its funds and into another of its funds, which raises all kinds of questions about who's doing the valuing.
Exactly. It's just a shell game. Yeah.
Is someone getting a good price, or is someone paying a higher price than they ought to? So you're starting to see this difficulty of the exit strategy that private equity requires. And it will be very interesting to watch that, in addition to the pressure of higher interest rates.
Okay. All right. Correct me if I'm being a little too overly dramatic here. But the way in which your book describes a lot of the behavior of these big guys is they are raiders to a certain extent, right? They come in and they load the companies up with debt, as you said. They have to dramatically cut costs. Back in the day, you could find undervalued companies, and this all worked actually pretty well, right? The company's organic value that it was creating through cash flows would begin to pay down the debts, and then you ended up with a company that was a lot more efficient. The debt's now under control. It's very attractive for a new buyer. Fast forward to where we are today, right, where valuations have gotten crazy, and I'm using the public markets as a benchmark for that, but
Right.
There's correlation between public and private market valuations. We look at things like the Buffett ratio, which is sort of a finger to the wind indicator of how well things are, whether things are fairly valued or not. And it's still up in nosebleed territory, right? So the problem is they used to buy these kind of diamonds in the rough with cheap debt. Now we're in a point in time where they're buying overvalued companies with expensive debt, right? That doesn't work very well. So for that model to work still, is you essentially have to find the patsy to sell to, right? You have to find the greater fool who's going to take this company off of your hands. And I want to take that question further in a second, but a quick one for you. I was just curious, are they siphoning profits out of these companies in the period in which they run them as well? So is the total return not just what they get at the end, but what they can kind of squeeze out of the company in the interim?
Yes, and that's a really important point to make. So one of the typical strategies, I call the private equity, these big private equity firms, I call them, they're in the extraction business. So they extract, it's like ExxonMobil, right? They extract assets and wealth and cash from these companies during the time that they own them. Now, not all of those assets, cash, et cetera, go back to the investor, i.e. the pension fund. Sometimes private equity firms charge pretty substantial fees that go to them, not their investors. And we can talk about that in a minute, because the SEC has gone after them for those fees because they were not disclosed appropriately. But yes, a typical strategy, Adam, would be if you buy a nursing home company, as Carlisle did when it bought Manor Care. You can, and Manor Care owned all of its land underlying the nursing homes, and the nursing homes were very well kept. And that's why Manor Care was an attractive asset to buy. It wasn't going to require refurbishing, investments. So Carlisle walks in, and then they decide to sell all of the underlying properties of the nursing homes. So they immediately get out everything that they invested.
Okay.
They take that out when they do the transaction, the real estate transaction. But guess what happens? Manor Care now has to pay rent.
Mm-hmm.
Manor Care now has to pay rent for all of those locations. And the company immediately started to lose money because there you go. All of a sudden they have a cost they didn't have before. The asset that they had before is now gone. Somebody else owns it, and they're left with the costs associated with that transaction. Manor Care ended up going bankrupt. And that was a crucial reason why the company failed, because of that transaction.
Okay,
Now,
so
go ahead.
Sorry, go ahead. No, you continue.
I was just going to say that the fees that I was talking about before that can be problematic are so-called monitoring fees. So when a private equity firm comes and takes over a company, they will, generally speaking, install people on the board of that company to make sure that it's being run properly so they can keep eyes and ears on it. They will also, they had in the past been taking out what's called monitoring fees for the, sort of management advice and monitoring that they were giving the companies as they turned them around. But what it was interesting was the SEC found that the companies would typically structure the monitoring fees for a 10-year contract. And so if the company was sold within 5 years, for example, the remaining 5 years of the monitoring fees had to be paid by the company to close the contract to make the deal work. Okay. So 5 years of fees for work that no one was doing. So that's the kind of thing that I'm talking about being an extraction business, extracting the wealth of the companies in that case. They also can take pensions and, they can sell the pensions off to someone else. That's the kinds of things that I think create the biggest problems for workers in these companies and really need to be examined.
Okay, so I just want to remind folks that we're talking about the worst of the abuses in this space, but
Yes.
they're not insignificant. In other words, we're not talking about a tiny fraction of transactions. You're saying the biggest players in the space have a history of these types of deals. So what I keep thinking when I hear you describe all this, Gretchen, is it's sort of a hollowing out of the company, right? In terms of its value. You're just mining, you're extracting, to use your word, the value out. And so I asked that question about whether they were able to do this in the interim before they sell it, because it sounds like it's true that there are a lot of ways they can sort of structure these deals where the private equity firm, which kind of at the end of the day is sort of an intermediary here between the providers of capital and the employees and the company itself. If it doesn't sell for a phenomenal multiple at the end, it still might work out well for the private equity firm because they're able to kind of extract all this value along the way. And of course, if it does sell, they pocket a lot of money. So I kind of go back to this sort of, it helps to find the patsy at the end of the day, right? Like when they were starting, you were selling a company that really was kind of right-sized and made much more efficient. Today, it sounds like it's much more of sort of a hollowed out husk. And I'm sure there's a lot of accounting gimmickry and stuff to try to show, oh, well, on these key metrics, we've made the company better over the past 10 years, and to try to sell it onto somebody else. Who do they usually sell these things to? When times are good, at least. I know you mentioned now they're kind of having trouble, but when times are good, who is the buyer of a private equity firm? Is it the public markets? Is it another private buyer? Is it a mixture?
Yeah, it's a mixture. So traditionally, they would be able to IPO these companies into the public market. They would often maintain their role, with people on the board from the private equity firm. The private equity firm would keep holding a stake in the company. But yes, you can issue public stock for in a new IPO and get out that way. Then you also had corporations that would be making acquisitions that were strategic, that worked for the companies that they had, that would have been additive for those companies if they made the acquisition. So it's, generally speaking, a mix. In recent years, it has become selling to other private equity firms. And that's kind of another indication of that we're in the late stages
Yeah.
of what was a very fruitful strategy for many years, but is becoming a little trickier.
All right, so I want to finish this topic and then move to another complementary one, because I'm trying to build a bigger understanding here of kind of how they got away with all this for so long. What's made it harder for them to, or why they're now selling to more private buyers, is because the public IPO window has closed for a good while during COVID and whatnot, and still not back to where it was. And this is sort of where I talk about the patsy, right? Where you can quote unquote kind of put lipstick on the pig, and then sell that to the public markets, because in many cases the public markets can be less discerning than really sophisticated private buyers. And I live out here in the San Francisco Bay Area. I spent a good chunk of my career working in Silicon Valley, and I became pretty jaded with how Silicon Valley, over my tenure there the past couple of decades, really, to me, seemed to sort of metastasize from a real generator of world-changing innovation to a, let's come up with the idea of the week, let's overhype it, let's get our other portfolio companies to be its first clients to show some really great sales growth off the bat, and then let's just IPO that thing and dump it on the retail market. And if it's ever going to be profitable, that's their problem to figure out, right? So is there a similar element there with private equity to date, where it was like, let's get this thing all gussied up after we've extracted as much as we can from it, and let's find some rube to dump the thing on for the multiple we want, then we walk away rich, and if this husk shrivels and dies after we've sold it, well, that's their problem.
Absolutely, Adam. That's a winning strategy, has been a winning strategy for them. And, as you say, just come up with the deal of the week or whatever, or the idea of the week, as they did in Silicon Valley. A very interesting sort of wrench was thrown into that idea, though, by a federal judge in New York called Jed Rakoff. Jed Rakoff is in the Southern District of New York, and he gets a lot of very interesting cases, but he was presiding over a case involving the bankruptcy of a private equity-owned retailer. And what he ruled in this case was, this was a situation where the retailer was sold, but it was sold to an entity that was going to put a lot of debt onto it. The company then failed because of the heavy debt load. And so there was a squabble and a bankruptcy. Okay. So the interesting piece of the Jed Rakoff ruling was that he said, and this really scared the living daylights out of the private equity industry, he said that the directors of the retailer had an obligation to make sure that the structure, the financial structure of the company would be sustainable going forward. So it was not going to just be that you get the highest price for the company. That was no longer going to be the litmus test for him. For him, he said, you are going to have to at least examine the capital structure to make sure that this company can survive. And if it is heavily leveraged with debt and it can't survive, then that's on you. And that was a really enlightened approach, I thought, to looking at transactions like these and acquisitions and dispositions of companies. If the board is suddenly on the hook for making sure that the buyer is not going to wreck the company with a capital structure that makes it too hard to survive, then they will be on the hook. I thought that was very interesting.
That is really interesting. and I love the spirit behind it, right? Which is, hey, let's prevent these patently unsustainable deals from getting done just to let these guys escape with their riches.
Right.
Of course, it raises the question, okay, well, who determines whether the model is sustainable or not? And I started my career on Wall Street, Gretchen, and long enough to know that, you know, you can hire an investment bank to
To
come
tell
up
you
with really
whatever
with
you want.
whatever opinion you want, right?
Yes.
So will this just be sort of a passing of the football, or do you think actually some real,
You know,
positive oversight will
it's a
come?
great question. Nothing has changed. Okay. That ruling was a couple of years ago. And I thought, Eureka, we're actually going to have people start to think about the capital structure of the company after the acquisition. No, nobody's doing it. No other judge ruled on it. Nothing has happened. Nothing has changed. So we haven't even gotten to the point where you hire somebody to say 1 + 1 = 3. So it just was an interesting moment where the accountability
Right.
problem here, the agency problem here was addressed.
Yeah, it is showing. I mean, maybe it's glacial at first, but a change in sentiment that, hey, maybe we're just not going to let these guys get away with it. And you also talked. So private equity is kind of famous for the 2 and 20, right?
Yes.
And you mentioned that there has been some pushback on that model. Anything specific or notable to talk about, or just people kind of challenging, like, why are we paying you such hefty fees through all this if you're going to make all this money on the back end?
Well, I think, it's changing. And I think the FT just had a story about how private equity firms are being forced to add sweeteners to the deals for their investors. So I think you're starting to see people push back on that. I mean, I think 2 and 20 is not paid by everyone. If you're a big, CalPERS or someone like that, you probably
You
can
can
get a
negotiate it
better,
down.
you can get a better deal, particularly on the 2 part. But it is very expensive. The other thing that people have to understand is that it is extremely opaque. You do not know what you own. You certainly don't have a sense of when you can get out of the companies. They do have a long hold period. The valuations are extremely kind of marked to wherever you want to mark them. Okay. Yeah. And you're starting to see more concern about that as well, Adam, where you have a public market valuation of a similar company that is drastically different from the valuation the private equity firm assigns to the similar company that it has in its portfolio. And you say, wow, wait, how can you value it twice what the public market says that kind of a company is worth? So I think you're starting to get questions from investors about these issues, but we're really in early days.
Yeah, and so private equity companies they're not beholden to as stringent financial reporting requirements as public companies. You're shaking your head at some things.
Yeah,
okay,
very few rules. They do not, and SEC is starting to get religion on this. They want more disclosures. They want more clarity. Investors should have been asking for this years ago, but the SEC is starting to put together new rules that would require more disclosure from these firms.
Okay. So I have an opinion, and I'm very curious to hear your perspective because you're so much more steeped in this than I am, but I was interviewing Dan Ariely, who's a prominent behavioral economist, the other week, and I'm fascinated by that field of study. And we talked about how human beings, just being human, there's kind of 2 ways to change your behavior. You project forward proactively and say, well, if I keep doing this, it's probably going to have that result. I should change my behavior today. Almost nobody does that. You only change when the pain of continuing the status quo becomes greater than the pain of changing. So usually you just slam headfirst into issues. And then when the dust settles, you say, okay, I don't want to do that again. That really hurt, right? And so it seems to me that my opinion is that a lot of these changes or reforms, improvements that we would hope are coming down the road, probably very few of them are going to be made by clear thinking and we just come up with a better rule set. It's going to come with some big injuries, some big investors getting hurt, or some big swath of companies going under and really injuring the labor force, or something like that. It's probably going to take some real crisis to really get the attention to make the big changes. Do you share that opinion, or are you maybe a little more hopeful?
Well, it's interesting. I went into the 2008 mortgage crisis believing that this was going to be such a seismic catastrophe, that there would be genuine reforms and there would be hell to pay. Okay. There would be accountability. People would go to jail for running these operations that were really so abusive. I just felt that that was such an enormous tragedy for so many people. I mean, people's furniture on the curb in front of their homes, people's children who could no longer go to the same school they were in because they had to move or live in their cars. I mean, we're talking real harm, genuine harm. And nothing really changed. Nobody of any, importance went to jail. Some people paid some enormous fines. And by the way, the people that paid those were the shareholders. They were not the people who actually, did the crime, quote unquote. So after that incident, I have a lot of doubts about anything that is going to have affect real change, because that was, again, such a big deal, and it didn't generate the kind of response that I felt it ought to have. And certainly there was very little accountability involved. So I'm having a hard time believing that there is going to be any accountability here. I, of course, am always hopeful. The reason I do what I do is to shed light on things and the idea that there will be change. So I am not a cynic. I do not go around thinking, oh, nothing will ever change, because the nature of my work is to hope that people will be educated and therefore change behavior. But I'm just kind of doubtful given the experience in 2008.
All right, so you're pretty much reinforcing my opinion. I was holding out a little bit of hope that I was missing something that was a little more optimistic, but I appreciate that. And I do want to just take a moment and really express my extreme gratitude for your work, Gretchen. I'm glad that it has been as recognized as it is, but it's so important. And as they say, sunlight's the best disinfectant. The way that we're going to get through this is really by just putting the practices that don't serve us clearly on the table in whatever way we can, to get the ecosystem to look at them and say, you know what, that's actually not the best way to do it. We need to start doing something differently. Like I said, the pessimist, or maybe just the realist in me, thinks it's probably going to be because we get our hands burned enough times that we finally say, okay, we got to start changing our behavior here. But as they say, when in a crisis, the solutions that get implemented are the ones that are already on the table. By the work you're doing, you're really putting the right thinking on the table, so that hopefully when we need to make drastic decisions in the future, we've got enough quality information to make a better decision than perhaps what we're pursuing right now.
Well, I hope so. The reason that I wanted to pursue this with my colleague Josh was to show people what happens to the folks on the other side of the transaction table. I mean, we know all about Steve Schwarzman, and we know all about David Rubenstein of Carlyle Group, and
Larry
Henry
Fink
Kravis of KKR. We know about them. They are covered every day. They are lionized in the media. They give away billions, and we know all about them. We do not know about the people who are on the other side of the table. And those are people you wouldn't even begin to understand how they could be hurt. So there's an incident in the book that I think it really crystallized this for me. It was an aluminum smelter in a very impoverished section of Missouri. And it was the only employer in town. 2,500 jobs relied on this. Apollo came in, bought the smelter. They extracted and extracted and extracted. They put debt on it. They got 3 times their money out, but the company went bankrupt. And when it went bankrupt, school children in the town in Missouri didn't have books. School teachers didn't have insurance, because the company was such a big part of the tax base in the town that when it went bankrupt, that tax base went away. There was also a wonderful anecdote of how, or telling anyway, anecdote of how the smelter, when it was having difficulty because it was so indebted, asked for a rate reduction from the utility commission in the state. And the utility commission finally granted the rate reduction, which meant that Apollo was paying less, but every other ratepayer in Missouri paid more.
Paid more.
So these are the kinds of folks you don't know about, we don't know about, who are on the other side of these transactions.
Yeah, and again, like I said, I have a lot of respect and gratitude for that work, because I think the general people, when you have these discussions, they think of this as financial chicanery, right? So, which it is in a lot of ways, but it's money moving around and it's all paper. And at the end of the day, it happens in this fairyland world that's Wall Street, and it's all funny money anyways, right? And it's not.
Right.
These are real companies making real things, supporting real communities. So, cost cutting, the workers get laid off or have their hours cut back or their pensions diminished, or you gave some great examples of the school. And what's sad is the reason why private equity goes after these companies like the smelter you're talking about is because they've got good cash flows. They've got good prospects, right? So they're taking what was a productive asset and then potentially kind of killing the golden goose, right? By just extracting too much from it. The other thing that we haven't talked about quite yet is we talked about sort of the other people's money that goes into these things. A good source of it, a fairly substantial source of it, are pensions, right? And so as you talk about, okay, these are sort of opaque investments, they're oftentimes kind of priced in a way you can't really trust during the time in which you're holding it. And you may end up now increasingly find out that you're holding a real dud at the end of this year, right? I've had people on the program who are pension reform experts who have opened our eyes to the fact that we think as pensions being traditionally, heavily loaded in bonds and other really safe assets. And he said in many cases now that's just no longer the case anymore. And they've been sold, particularly because of a ZIRP environment, right? Where it's so hard to get the rate of return that you in safe assets to meet your actuarial requirements, that the siren song of the bigger gains that you could get in private equity really started persuading them. And a lot of these pension boards, are staffed substantially by the workers that the pension is for, and they're not sophisticated investors, so they can pretty easily get razzle dazzled by a Wall Street type that's selling them this next great private equity thing. So another big bag holder are the pension firms, and I care much less about the firms themselves, but more about the people depending on those firms for their pensions. So there's a big risk there too, correct?
True, totally true. The beneficiaries are the ones, of course, who will have to pay. And if, by the way, there is a pension problem, then the taxpayers can also be on the hook. For instance, if there's a corporate pension that goes bankrupt that used to be backed by the PBGC, then that's taxpayers who end up picking up the slack there. But yeah, no, the pension funds and their predilection for private equity, you understood it in the years when the alpha was being created in a very big way. You understood it when the bond market, bonds, because of low interest rates, were just, practically returning nothing. But it really is a strategy that has a circle of pain that's pretty large attached to it. And so it's been a pretty perplexing thing for me to watch the pension funds dive in so deeply into this kind of business model that really is not sustainable. The business model that actually, fires the very people that the pension funds have as their beneficiaries. Okay, so in Missouri, the case of the smelter, the teachers were the ones who were hurt. So the teacher pension in Missouri, so why are these people buying into an investment concept that ends up hurting the very beneficiaries that they are serving? Yes, it did return higher rates before. It is no longer doing that. That's why I'm hopeful we're going to have kind of a reckoning among pension funds on this topic.
Yeah. So I'm right there with you, and it's a dangerous thing to say out loud, right? And I don't want the reckoning because I hate pensions and pensioners. I want the reckoning for the global reason where I just think we have a system that is metastasized, for lack of a better word, to really rewarding a very few inside power players and really damaging the average person in ways you and I have been discussing here. And if there is a reckoning, I memean, there's going to be a lot of pensioners that are hit really hard by it. And to your point, there will probably be a lot of taxpayer funded bailouts of those pension funds, which is unjust in and of itself too, because a lot of those taxpayers do not have a pension.
Right.
So when we look at, people's readiness for retirement in this country, it's really scary. And for somebody who already has diminished prospects to have their taxes go up because they've got to bail out, a pension that wasn't well managed, I mean, that's like a double injury there. And
Absolutely.
I do worry about the sort of social ire that could really create if we end up in that type of situation.
And especially if you think about the bailout occurring, basically you're bailing out the entities that made these investments, who made a tremendous amount of money making the investments,
right?
Extracting all those fees, et cetera. And you're really bailing them out, which is, unfortunate.
Unfortunate, and like you said earlier, you expected there to be some pretty dramatic reform post global financial crisis, and we didn't really see the accountability we're looking for. It just blows my mind that Wall Street paid itself record bonuses in 2009, right?
Yeah.
I mean,
right.
and my point is, we've seen this movie before, right? Where these guys who perpetrate it get to skate. All right, so we haven't talked about one other key ingredient here to the success of this sort of bastardized model that you've been talking about, which is regulation. You need to have regulators that are more or less kind of asleep at the wheel, toothless in terms of what they can do in terms of enforcement, or I don't know, might be kind of complicit in the deal, somewhat captured by the big moneyed interest on Wall Street. So talk for a moment about how the lack of regulatory enforcement has enabled this bad model.
Well, certainly the lack of information and the disclosure problems associated with these companies has been a problem that could have been addressed many years ago. Now, these are private companies, and that's why the disclosures are sparse. They don't have to file 10 Qs and 10 Ks and proxies. But the government could have stepped in and said, look, this is a big business, pensions are involved, and so therefore we need to know more. So they did not do that. They have only just started to talk about increasing the disclosure requirements for these entities. We also do not know the degree to which they are significantly impactful financial institutions who could, if they failed, bring down the economy or start a domino reaction. We don't know enough about these firms. They are enormous, we know that, but we don't know about the interconnectedness that goes on in some of these financial entities. So government could have been far more vigilant about the information that's required. As far as other elements that have been lacking, the FTC and the DOJ have not gone after acquisitions of companies. They have not looked at it holistically in the sort of way that private equity rolls up small businesses, but as they roll them up, like physician practices, for example, as they roll up physician practices, they gain a market hegemony that you really don't want to have. They gain market control, but you don't even realize it because it's kind of stealth. And these have been small companies. They didn't meet the threshold for antitrust action. So I think we need to start seeing a rethink of that. And maybe we are under Lena Khan at the FTC. So you do need to have more examination of market control and how these companies are able to achieve it kind of under the radar.
Okay. You're making me think of one very specific instance that I'd love to get your quick thoughts on right on this topic is, when you're talking about the roll-ups of the healthcare companies. We'll talk about Blackstone. Right. Just as an example, they're buying up a massive amount of single family homes.
Yes.
Right. Of residential real estate. Right. Is that a concern that we basically have these deep pocketed institutional investors now coming in and owning an increasingly large share of our residential housing stock and essentially kind of outcompeting average people for an essential necessity of life.
Yes. And of course, you have, when Blackstone is bidding for properties in your town, that means that you are being outgunned by a, fill in the number, $1 trillion company who
can
has,
borrow at much lower rates than you too, by the way.
absolutely, and has, bottomless pockets. And so, yes, it is having the impact. And I have seen the studies about creating a situation where first-time home buyers, for instance, cannot buy the home that they would have been able to buy years before Blackstone and other big private equity firms got into the single family home industry. You also have the problem of these large landlords who have systems and, are not responsive. I've written about this extensively, not necessarily about Blackstone alone, but others, where the people who are in the homes can't reach them, can't get things fixed. The grass isn't mowed, the maintenance
just
isn't
stuck in a
done.
bureaucracy. Yeah.
They're stuck in a bureaucracy. And again, it comes to the point where we're trying to make these things more efficient. So of course, yeah, it is more efficient if you don't cut the grass. It is more efficient if you don't improve, fix the pipes, or if you don't have heat in the winter. So it's this claim of efficiency, Adam, that really gets to me, because how efficient is it, and what cost is the efficiency coming? The cost to the customers, the cost to the employees. There's a really just so damaging academic study about nursing homes that are taken over by private equity, that residents in those nursing homes experience 10% greater mortality rates than residents of nursing homes owned by other companies, even for-profit companies. 10% mortality rates greater. That was 20,000 people who died in private equity owned nursing homes over this period this academic study did. That's the efficiencies they're talking about. Lower staff, people not around to watch and care for these residents. It's really this claim of efficiency without really discussing the cost of the efficiency.
Yeah, it's a wolf in sheep's clothing story, and sadly, I think you're kind of putting your finger directly on my wound of how much pain are we going to have to take before we start saying, we as a society and our legislators and everything and our regulators start saying, okay, look, we need something different and better, right? Clearly 10% mortality rate in nursing homes is not enough pain, right? And so that's a little scary, which is, okay, if that's not enough pain, what is going to be, right?
Right.
All right. So we've been taking a lot of gut shots at the private equity punching bag here. As I mentioned at the beginning of the interview, we did have the CEO of a private equity firm on not that long ago, kind of educating us about how private equity works and the benefits of the space, the potential benefits of the space. He totally acknowledged that there are a lot of transgressions that go on. I'm actually excited to get him back on the program at some point to let him react to kind of what you've laid out in your book. But let me ask you this, Gretchen. Is the case with private equity that it's just a bad model? Or are we talking about a model that can be used for shareholder and stakeholder good? It's just being abused by bad actors?
I think the model would have to be tweaked or changed. Okay, so again, we go back to the pressure points of the heavy debt that's used to acquire the companies, which adds to the costs of running the companies, and the short time frame. So I would argue that if you were a private equity firm who was going to put more of your own skin in the game, more of your own money at stake, and who had a longer time frame, so that would be an answer to these issues. And so companies that are doing that, private equity firms that are putting more of their own skin in the game and that are taking a longer view, I think, can absolutely do the right thing for a wide array of stakeholders. But it's this heavy leverage, short-termism that really contributes, I think, to the problem. And that business model, I think, is just unsustainable.
Unsustainable. And so it's interesting here, and maybe let me try to end on something optimistic here, which is maybe we get the kind of reckoning that you think is deserved for the unsustainable models that are in the private equity world, right? And again, if interest rates don't come down anytime soon, they're kind of losing their oxygen to be able to survive at these this cost of capital. So we may have a natural culling at this level anyways, right? But that may send more of the spoils to the survivors in the private equity space who were doing things right. One of the things that CEO talked about was that it was, a big part of it was this longer term view, right? Where you're not stuck in the short termism of, oh, what do we get a goose this quarter to hit our earnings number, right? So you can really invest for the long haul, right? What he also mentioned too, and I'd like to get your thoughts on this, is one of the things that he thought was sort of so exciting about the future of private equity is that it is large and growing from a capital standpoint, and that more and more companies are choosing to not go public because they just don't have to, right? And yes, there's a lot more transparency that happens when you go public, which is good, but there's a lot of things, the short-termism and other just friction that aren't necessarily super helpful. And so in a company used as an example was SpaceX, right? Where SpaceX requires a gargantuan amount of capital. It's the kind of company that absolutely had to go public a couple of decades ago to raise that much money. It didn't have to anymore because there's enough private wealth sloshing around that it's able to fund itself currently. And at some point, SpaceX is going to be beyond the R&D phase, and they're just going to be purely operating an incredibly profitable, space transport company at some point soon. It's going to be phenomenal. And the public market investors, the average, mom and pop who buy, a couple of shares of X, Y, or Z or whatever, they've missed out on that entirely because it never went public, right? So, there may be some real promise in this space for companies that are really run the right way. Do you agree with any of that? Am I being too Pollyannish here?
I think so. And I think that the idea of extending out your time horizon is crucial, because that's the way you build the company. You're not just extracting the wealth out of it and then flipping it. I hesitate to say that I am in favor of fewer public companies, because how on earth are, investors going to be able to have a prosperous retirement if they can't access the public equity markets? Those have been the biggest source of wealth for individual investors, right? And I would hate to shunt people into a strategy that is extremely expensive, very opaque, and allows for some significant shenanigans. So yes, I think that it can be workable, and if changed in certain ways. But I really hope that we don't have a world where everybody is private, and so therefore the individual investor can't participate in the wealth creation that does go on, in the S&P 500, the Russell 2000, whatever group of companies you want to talk about.
Yeah, well, I think one key element here, which you probably mentioned, but just to underscore, is I think no matter what markets you're investing in, more transparency never hurts, right?
That's right.
Yeah. All right. Well, look,
and that's what you do. You bring transparency to it. So thank you for that.
Well, thank you. I try. And look, I'm just struggling to crawl along in your big footsteps that you've left behind.
Oh my gosh!
So
don't
thank
be
you.
ridiculous.
Let me ask you this, just in parting here. And I'm going to ask in a moment where folks can go get a copy of your book. But you've had a long career with a laser focus on the excesses that have happened in Wall Street. You covered deeply the mortgage crisis that led to the GFC. That was the topic of your book, Reckless Endangerment, if I remember correctly. And then you talked about you really revealed large conflicts of interests amongst the major brokerage houses. This was back earlier, coming out of the .com era. I think that's what you got your Pulitzer for.
Right.
How bad does what you're seeing in today's world, not just private equity, but just sort of in the the tenor and the context of how the financial system and Wall Street are being run right now, how do they compare to those eras? Are we in a materially better place, or do you see a lot of concerns as you look around the landscape where you feel like we still have similar vulnerabilities like we had back in those extreme eras?
Well, I think the good news, Adam, is that the banking system is much stronger than it was, and our banks are doing pretty well. They're really, they're not perfect, but they're in much better shape than they were, and in much better shape than banks, in other nations. So that's a really, really important positive that came out of the 2008 crisis. I do think that we have systemically important financial institutions that we don't recognize because they're private, and we do need more sunlight on those. But at the moment, the banking system is pretty sound, which is a huge deal. But I think that, investors need to have confidence that they know the regulators are on their side, that they're working diligently to protect them. And sometimes I just worry that we just don't have a strong enough system in place to protect individual investors from, the what I would consider to be questionable practices that Wall Street is known for, and Wall Street has always been known for. And so you just want to make sure that we do have those police cops on the beat who are making sure that investors can have confidence in the markets in this country.
All right. Well, again, thank you so much for the work that you do, which really beat that drum that we need to have that type of monitoring and public focused outcome enforcement in these markets. And hopefully with your drum and other people following your lead, maybe maybe eventually more and more of our legislatures will hear it, and they'll start passing, they'll start giving the regulators more teeth and maybe a little bit more pressure to say, hey, buddy, do your job here, make real reform happen. All right. So as we wrap up here, Gretchen, this has been wonderful. Thank you so much. If people want to read your book, your new book, where should they go?
Well, you can buy it online. You can buy it at Barnes and Noble. You can buy it at Amazon, but go to your local bookstore and support your local bookstore if you can. And if they don't have it, make them order it.
All right. Yeah.
It's easy to find.
I guess a book that's already a Wall Street bestseller, Wall Street Journal bestseller, is pretty much sold anywhere they sell books. So your local bookseller should be able to get it.
I would hope so. And if not, let me know and I'll go and, pound on their heads.
All right, great. And if folks want to follow you and your work above and beyond reading your book, what's the best way to do that?
I am the senior financial reporter in the investigations unit at NBC News. And so you can read my work on NBCnews.com. There's no paywall. And I really would welcome as many readers as possible. Happy to interact. My email is at the bottom of every story, so you can find me.
You are courageous to do that. And Gretchen, when we edit this, I'll put up the link to NBC News here on the screen. I'll also put it in the description below, folks, so you can know exactly where to go to follow her. Gretchen, this has just been wonderful. Thank you so much.
Well, folks, thank you for your really, really thoughtful and incisive questions. Seriously, a lot of people just don't have the expertise that you do. So very grateful for that.
Well, thank you. This has been a pleasure and a true joy. Thanks so much, Gretchen. Really appreciate it.
We'll do it again.